Good morning, everyone. Tim Nyland here. Today is Wednesday, March 17th, and this is our weekly strategy call for Zacks Professional Services. Each week, we focus in on what's moving the market. If you have a topic you'd like me to explore in a future video, please leave a comment below. You can also check out previous strategy calls on our channel, and you'll also find many more videos on investing and making the most of Zacks Pro platforms. And don't forget to hit the subscribe button below to make sure you never miss any of our future calls. This week, as I continue to move forward with the quarter-end reevaluation of the earnings certain family of equity model portfolios, I'm going to go ahead and give you my thoughts on inflation and the technology sector valuations as a whole. And one of the main articles that prompted this particular webinar was something that was released, I believe it was last Friday, and it's obviously up on the screen here. It was a Ned Davis research piece that appeared on CNBC. The headline on it was, at 2% 10-year yield could knock 20% off tech stocks. And the reason why this was so shocking to me was the number of advisors that reached out to me regarding this article. And so I actually subscribed to CNBC Pro just so I could read the article, so that I could, field the inquiries on this particular piece of research. And so that's more or less what triggered this week's strategy session. So what I want to make sure that everybody understands is that this particular piece does have some valid points, but what we have to remember is that not all tech is equal. And so let's look at how this scenario may unfold for at least a portion of tech. And let's take a look at what the real concerns are, not only for the credit markets and fixed income investors, but also equity investors. I know you guys have seen a lot and heard a lot about the M2 money supply. And what I want to do is offer up a different perspective and a visual perspective of exactly what's going on with M2 itself. And let's keep in mind that the M2 money supply consists of literally cash, checking, CDs, money market accounts, mutual funds, and what they classify as other near money. So it's a much more broad a broad measure of cash, if you will, in the economy. And the idea here is that when you're looking at M2 money supply, I've seen this chart time and time again, the one that's up on the screen. This is a Zacks research system chart. You can also get it out of Advisor Tools. And keep in mind that M2 money supply, as you can tell from this chart, it's a growth series, right? Naturally, the M2 money supply is going to increase as population growth increases. And the interesting thing is that most of the time when you're looking at growth series, even series like GDP, unless you transform the series itself, it's pretty much worthless to look at in this type of linear fashion. The interesting thing about the magnitude of the COVID relief is that you can see this tremendous spike in M2 here in 2020. And so I've circled that in red. So what we're going to do is we're going to look at this chart the proper way, which is to basically transform the underlying raw data series to a 1-year percent change. And so again, M2 being a growth series, and like any growth series, the real way to analyze the series itself is you have to look at 1-year percent change. And there's some important takeaways here outside of the obvious spike here due to COVID and all the relief packages that have been passed. We're looking at literally 26% increase in the M2 money supply, which is massive. And you can see where we peaked here in the great financial recession, QE1, QE2, and all of those related bailout packages after the financial crisis. The next slide, again, all I'm doing is highlighting that for you so you can see exactly where we peaked out, right around 10% year-over-year change in M2 money supply. And interestingly enough, when we start looking at M2 and trying to determine inflationary implications, what we really need to do is look at the velocity of M2. And so this is literally a measure of how much cash is getting into the economy. So, it's one thing for for the Fed and the U.S. government to increase the money supply. But I've got 3 points down here in the lower left of this slide, 3 things that have to happen in order to increase the velocity of money, which is what's really going to drive inflation. It's not just increasing the money supply. Those monies in the economy, that increase in money supply, has to chase goods and services for there to actually be inflation. One of the real naive explanations of inflation that I like to use is inflation is can be naively defined as just too much money chasing too few goods. And so velocity of M2 measures just that. It's literally GDP divided by the M2 money supply. So the idea here is that since 2001, we can see that the velocity of M2 money has just been cascading down. And so the idea is that in order for inflation to finally pick up, we've got to have banks start lending. We need to have consumers start spending, and we need corporations to start spending. And if you think about it, it makes sense. And just take a look at the size of the cash positions on the balance sheets of the tech sectors, for instance, and healthcare and all these other sectors. I mean, we've got bellwether stocks and bellwether companies out there that have never had this much cash on their balance sheet. So at some point, if we're going to get inflation and we're going to see velocity of M2 increase, we've got to get this turnover in the economy. And that's what the velocity of M2 is. So again, trying to take you through the charts and just explain this in a very, very basic manner, the way that I look at it. Sometimes when you read the journal and you read other publications and you listen to this stuff and you see the charts, it's really hard to, come away with any real conclusions. And so what I'm going to do is I'm going to continue to paint this picture for you now. Instead of looking at that cascading downward sloping velocity of M2, again, what I like to do is transform the series and look at the 1-year percent change. And the way I like to explain the 1-year percent change of this ratio of GDP to M2, which is the velocity of M2, is the lower this ratio goes on a 1-year percent change basis, the more fuel is being added to the fire to potentially stoke the flames of inflation. So you can see here we had a fair amount of fuel coming out of the financial crisis, and you can see velocity really accelerated. But we've got literally more than double the fuel now. And so the idea is, based on history, and we know we've got a lot of consumer pent-up demand for travel and leisure and everything else, what's the expectation of the velocity of M2 off the back of this COVID crisis? So what we want to do now is overlay the 10-year Treasury yield to this 1-year percent change. And this is really the only way you can make sense of Treasury yields and the velocity of M2. You can't just look at money supply. You can't just look at the 10-year Treasury. And you can't even look at the velocity of M2 relative to 10-year yields. You have to transform the velocity of M2 to a 1-year percent change in order to make sense of this. Now you can see there's some soft, light correlations here that we need to kind of sift through. And you can see, obviously, as this velocity of M2 cascaded down, as did the 10-year Treasury, now we're on the rebound. And if you follow this over, I think the 10-year Treasury is sitting right around the 1.5s, 1.6s here. So we've come up a little bit. This is month-end data as of 2/28. So at any rate, what I like to do, again, is just paint a picture for you and just kind of show you some of these trends that you'll want to watch for. And it's fairly consistent, the trending of this 1-year percent change in the velocity of M2 relative to rates. And you can see I've painted some really, really, I'm going to call them naive trend lines again. Again, it doesn't take much to see these trends and how they correlate. The big one here that we're worried about is what happened here from 2016. Obviously, we had 1-year percent change in velocity of money shoot up. As it did, we had interest rates follow that almost in lockstep. And then obviously, as the velocity of M2 cascaded, you can see what's going on here with the 10-year. And obviously, where we're at now with vaccines ahead of schedule and everything else, I think this is the real fear for not only the credit markets, but for the buy side is if we get this M2 to accelerate this velocity, which I would imagine we will, the 10-year is more or less sure to follow. And so that's the real risk. So now let's shift our focus to the tech sector specifically. And let's first distinguish that there's two types of technology groupings, if you will. And we're going to paint this picture with a really, really broad stroke. Obviously, there's a lot more to tech than just that. But when we look at this relative to interest rates and the downside capture potential, we have to separate the mega cap tech group away from what I call the high beta, the Cathie Wood type stocks, the ARK holdings, crypto, all the development stage companies with negative earnings. Those are in a class all their own. And I'm going to show you how this looks here right now. So this particular chart that I have on the screen right now is basically your mega cap tech PE F12M versus the S&P 500. And if you look at the chart very carefully, you'll see this, what I have circled here below. You can see that the earnings certain tilts portfolio, again, this is mega cap tech, right? So this is Apple, Amazon, Microsoft, Adobe, Google, and Facebook compositized into a single, basically representing that group of 6 names as a single stock. We do that with the composite facility out of the research system. And you can see that we're darn near trading at its 5-year median, right? 5-year median is roughly 38. We're sitting at 39 and a quarter. It's very, very close. And keep in mind that when you look at the S&P 500, we're sitting at very, very much so elevated levels, and relative to its 5-year median. So the 5-year median for the S&P 500 is 17.9. We always call it 18. You can see that we're trading at about 22.5 right now. And the interesting thing is that the 10-year Treasury yields have been as high as 3.2% for a good portion of this time frame here in 17 and 18, when these PEs for the earnings certain, the tilts, the mega cap techs, were elevated. So the idea here is that as we move into the next slide, keep in mind here, S&P 500 remains elevated above its 5-year median. And so when we look at the earnings certain tilts portfolio, we look at the current point of PE, and it's about 39.27. I just literally drew a line back here, and I saw that in 2017, 2018, we actually sustained levels of PE F12M much higher than current levels, with rates much higher than current levels. As a matter of fact, with the 10-year at 2 times the rate it currently is now. Okay. When we look at the S&P 500, we can see that we have no history of the S&P 500 sustaining basically we'll call it I have in here 24x. It's really 22.49 with a 10-year Treasury over 1.5, let alone a 3.2. So here we are at 1.5, and we're sitting at 22.49. There's obviously another factor that needs to be considered in here, and that's the point of this slide. Is the PE F12M at nosebleed levels for the S&P 500? You'll see up here I have on the slide, not really. And I've preached this time and time again for all of those people that focus solely on the 10-year Treasury as trying to determine the likelihood of PE multiple expansion and contraction. You're barking up the wrong tree. You cannot look at the 10-year Treasury in isolation, right? We have to incorporate equity risk premium. So this is pretty much the nail in the coffin for the argument. So let me explain to you what you're looking at here. We're looking at the S&P 500 PE F12M up in the top panel. And you can see our elevated levels of forward multiple. And you can see those same exact elevated levels of forward multiple back here off of the recovery from the dot-com bust. And you can see the 9/11 PE multiple contraction here and then the recovery. But what I want everybody to see is that 10-year Treasury yields, when we had the same exact PE levels as we do now from 2020 all the way back to 2001, we had 10-year Treasury yields fluctuating between 5.5 and 4.2. Right now, we're at 1.26. Okay, so we've been at these levels of PE with this level of Treasury yield. The real driver of the multiple expansion isn't necessarily the 10-year in isolation. It's a combination of that and equity risk premium. Take a look at the low levels of equity risk premium. And again, this is the premium that investors require to simply have exposure in the equity class of securities. So it's measuring the flow of funds between the risk-free basket, which is the 10-year Treasury, and the equity market, our market basket portfolio, which happens to be the earnings certain portfolio. So we're measuring those fund flows, and we're actually giving it a value in terms of a percentage risk premium. We add equity risk premium to the risk-free rate. That gets us our total equity discount rate. And that total equity discount rate is what everybody is really afraid of in terms of these tech valuations. Okay, so keep in mind, do not look at the 10-year Treasury in isolation. Look at it in conjunction with equity risk premium. You can see the correlation here, how correlated equity risk premium is to PE, and you can see that there's actually not that much correlation when you look at it relative to equity risk premium for the 10-year Treasury. And you can see that here in these times of crisis for sure, right? So we had this 10-year Treasury collapse, at which point you would think that we would have a multiple expansion, and we had a multiple collapse. It was the same thing here, right? So yields collapsed, PEs collapsed. Well, if having low interest rates were so good, why did the PE collapse? Well, we had a crisis. Equity risk premium caught it. Here's the risk premium. Investors were requiring almost a 7.5% equity risk premium just to be in equities during the time of COVID. Well, it was that rapid rise in equity risk premium that collapsed the PEs. It wasn't the decline in treasuries that was moving against it. So again, you've got to look at equity risk premium. And this is a series I've been calculating for over 25 years. It's part of the earnings certain family of portfolios methodology. And it's one of the best in the business. And if you have any questions about it, you can reach directly out to me. There'll be email information, contact information at the end of this presentation. Also, wanted to comment, this slide deck is available to anybody who would like it. Just go ahead and email us a request and we'll get it right out to you. I do encourage everyone to study these charts. This is a really, really good presentation deck. Okay, so here's where the rubber hits the road with regards to mega cap tech. And we've seen mega cap tech have a really solid week this week. I would love to see that continue. It's certainly in the cards relative to the charts. And so when we look at mega cap tech, again, this is the 6 macro tilt stocks that are part of the ECP macro tilt portfolio. If we look at this relative to the S&P 500 on a PE F12M basis, you can see that mega cap tech is sitting comfortably below 1 standard deviation relative to the S&P 500 S&P PE F12M. So valuations, again, haven't been this cheap since 2012. And I'm literally just comparing the current point here, the 175, to where we were within this range off the back end of the great financial crisis here, 2009, 10, 11, and 12. We've literally been trading above this in terms of a premium on the S&P 500 since 2012. So the current is 1.75, so a 75% premium. Normally, we trade it at a little bit over 2x. So the median is actually 2.07, okay? And that's basically since 2001, those stats, okay? So now let's take a look at mega cap tech, PE F12M relative to the NASDAQ 100. So this would be the triple Qs. And again, no concerns here. Mega cap tech, again, sitting comfortably below 1 standard deviation. Haven't been this cheap again since 2012. Okay. Normally trades at a 36%, normally trades at a 56% premium, currently trading at a 36% premium. The low is only a 4% premium. That was set at the very bottom of the financial crisis. Okay. So we are in a very comfortable range with mega cap technology. So when we start taking a look at mega cap tech relative to high beta tech, here's where I'm issuing the red flag warning. And this is really where the article that I was showing in the beginning of the presentation, the Ned Davis piece, is really, really honing in on. And all I'm going to do is show you one example, which is PayPal. There are a ton of them out there. PayPal is one that I call a more high beta type holding that actually has earnings. Remember, a lot of these companies don't even have earnings, they're development stage. Okay. So when we look at the PEs, I want you to see how PayPal's PE trended over the last 5 years, almost mirrored the PE ratio of the earnings certain tilt portfolio. So these are the mega cap tech stocks. And then we had this decoupling event, COVID, right, where everything went digital. And I get it. Maybe PayPal gets a little bit of a premium. And then we had this reopening phenomenon. And we had the expectation of inflation, rates rising, and all that. And you can see that the earnings certain tilts, the mega cap techs, right, the PE is contracting here. So we're getting basically flat price with an earnings catch up. We've got earnings obviously increasing in excess of 20% each year, and that's leading to this multiple contraction. Apple's been a little bit soft as of late, so there probably has been a touch of price decline here as well, contributing to that. But what I want you to see is this red vertical bar that I drew. This is our inflection point. This is where the decoupling actually took place. And stocks like PayPal, and you could literally just go through the entire Cathie Wood, the ARC list, you name it. These companies' PEs just literally continued to expand even in the face of rising interest rates, to the point now where PayPal is trading at a 68 multiple, and you can grab any one of the mega cap tech names that has reliable earnings for a multiple of about 39 and a quarter. So keep in mind, PayPal is only one example. I love PayPal. Okay, it's just one example of the many high beta tech names that's literally trading at greater than +2 standard deviations away from their 5-year mean. I should say their 5-year median PE F12M relative to the mega cap tech group. So again, this is taking place as interest rates rise, and you can see this inflection point right here. And we just literally shot to the moon, +2 standard deviations in excess. The median PayPal PE relative to the mega cap tech group is only an 8% premium over the last 5 years. It's now trading at a 74% premium. That's the magnitude of the run in these high beta tech names. Okay, so red flag warning. How bad could the sell-off in high beta tech get? Again, nothing against PayPal. I'm simply using PayPal as an example because it actually has positive earnings and it's a high beta tech name. But what I want you to see is that if we just look at PayPal in isolation, again, using the research system, I've got literally a 5-year chart of PE F12M. It'll give you the stats, median and current, right? The 5-year median is 40 and a quarter. The current PE is 69.48. If you click on this little bar chart icon right here that I've got my mouse on in the upper left corner of the chart, you will actually transform the chart to a bar chart. And from here, you can actually model PE ratio change impact on price. Okay. So if we use PayPal again as an example and we hold EPS growth constant, we can literally model the price decline necessary for the current PE F12M of 69.48 to converge on that 5-year median PE of 40 and a quarter. And so I did this just by holding down the arrow key on my keyboard after I activated this arrow tool down here. So I just literally clicked the down arrow once and then on my keyboard held the arrow key down. And it literally brought this theoretical PE down to its current, down to its 5-year median, which is 40.28. And you can see that the price for PayPal would actually have to decline by 41.18%, down to $146 if the PE F12M actually reverted to its 5-year median. Okay, so that's how much risk is baked into some of these high beta tech names. Yes, we're in a technological revolution. Yes, companies like PayPal are in demand more now than ever, but we do have a reopening going on. We do have people that want to get out and spend in person. And the question we have to ask ourselves with all of these high beta tech names is it too far too fast? Rates are rising. These are high duration, high risk names. And what happens if, demand for their services falter just a little bit. These guys are literally priced to perfection. Well, you're seeing it right here. We literally just modeled it. So again, nothing against PayPal. There's a whole group of these companies out there that we've got to be careful with. Okay. So let's talk about some takeaways here. An increase in M2 money supply in isolation will not cause inflation. Okay. That doesn't mean necessarily anything. The rubber has to hit the road. The money has to be deployed in the economy. And that's where the velocity of the M2 money supply, and that's why this is the preferred measure of how much M2 is actually being released into the economy relative to GDP. It certainly is a better indication of inflation to come and rising rates. So watch the 1-year percent change in the velocity of M2 as your indicator for how the credit markets are likely to respond with, and I like to call these changes in interest rates, they're really supply and demand bids at each tranche of Treasury maturity is what you're looking at. And I've given an example here in bullet point 4, and I really, for all the, excuse me, let me go back, I just clicked accidentally. For all the advisors out there watching, think about this for a second. If you get the velocity of M2 money supply trending up, right? Credit markets are going to want to sell the long end of the yield curve and buy the short end of the curve to basically shorten the duration of their portfolios. And that's to basically protect against principal loss as the value of bonds decline because rates are rising, right? So the idea is to shorten up the duration of the portfolios. This will obviously cause long-term rates to rise, spreads to widen, and the yield curve to steepen. And this is what's obviously driven all the financial names because that's always good for banks, okay? So that point number 4 is super, super important. Mega cap tech names, again, Apple, Google, Facebook, Microsoft, Adobe, Amazon, they are well suited in this environment. Literally at their current valuations, they are very low duration. They are making money now. Most of them are paying dividends now. They have unwavering growth and literally the strongest balance sheets in the entire North American equity universe. As I mentioned before, look for divergence in technology names. I think this is really what that Ned Davis article was about. The high beta names are more likely to get battered as rates rise versus the mega cap names. The mega cap tech names, they're going to exhibit more stable valuations, balance sheet quality alone, let alone the fact that these multiples have already come in since September. I've shown you the charts, and again, please request this deck if you'd like it for your own personal reference, or even to share with your clients. Perhaps even more important of all, be careful when you're trying to draw conclusions regarding interest rates and PE multiples. It's really the levels of equity risk premium combined with interest rates, and you've got to look at this stuff relative to its own history. You can't just look at 10-year yields in isolation, and you can't just look at equity risk premium in isolation. You've got to look at a long-term trend to be able to really extrapolate any conclusions out of that. And that's basically what we did in this presentation. That's about all I've got for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or requests, please leave a comment below or feel free to email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and my Twitter handle is @TimNyland. If you're interested in getting started with advisor tools or the Zacks research system, or you're looking to upgrade your current subscription, or you just want a copy of today's presentation deck, please contact our world-class support at advisortools@zacks.com and zrs@zacks.com. Thank you very much for watching. I'll talk to you next week.